Over the last month, we can see there is red right across every single industry, with many companies in fact down double digit. And today our focus on Realty Income, which sits within the real estate space, has also seen a large drop across many individual companies, but Realty Income themselves, whilst the Mag 7 in particular are down, are up around 1% just over the last 30 days. Now when we expand this to year to date, we can see fairly mixed performance. While some companies are starting to rebound, pretty much every single one in the Mag 7 in the technology industry has suffered quite enormously, whereas REITs have actually started to perform fairly well. In fact, some of them are up double digits, with Realty Income up more than 6%. Now the wider reason for why we are starting to see a drop, at least in the last 30 days, is this constant talk of Trump and these new tariffs, and this is increasing global tension amidst what could possibly be the start of a trade war, and that is reflected in investor sentiment, as we currently are sitting in fear. Not that long ago, in fact, we were deep down into extreme fear, and our main focus today is on Realty Income. Investors love this because they pay a dividend every single month. In fact, the current yield on offer is near the 6% point. Both Quant and Seeking Alpha give this company a buy rating, with Wall Street 3.47, not far off the 3.5 to turn this into a buy. And we can see quite a large pullback from their 52-week high, where it sat at $65. At the moment, it's trading in the mid to lower end of the 52-week range. And for those that have been a longer-term shareholder, well, you would be up only around 9%. We're going to show you later in the episode that total return if you had reinvested your dividends. And we can see the pre-COVID drop. The company in February 2020 was trading at $82. It has not at this point in time recovered to those levels. Again, something we're going to discuss throughout the episode. We want to firstly point out that on a forward P to AFFO, the adjusted funds from operation, a metric for valuation we use for REITs as opposed to price to equity, we can see 13.3. It is significantly lower than the 5-year average of 16.3. This is what we would call a severe undervaluation signal, and one of the lowest P to AFFOs, not only in their 5-year history, but also in comparison to the sector. Again, we will note this later on. We also can point their yield of 5.7%, well above the 5-year average of 4.8, which is another undervaluation signal from dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year, something we have just noted. We also want to reflect on another valuation model that we typically use on this channel, although bear in mind we're not looking at any one of these models in isolation. We will conclude towards the end when we run it through our own process. But the blue tunnel here, the expected fair value, right now we see the company trading well below even the bottom end. There's disparity here, and therefore that equates to severe undervaluation, one that you can see over the last 12 months. Actually, Realty Income has been trading in the undervaluation space, and hence they do get a B- on the valuation grade. As we said, we don't typically look at PEs for these companies in real estate space, but on a price to adjusted funds from operation, where they trade around 13.3, that is below the sector comparative at 15.5, meaning they're trading at a 15% discount. But as always, some companies do deserve to be trading at a discount. In relation to the sector, we have points like growth and profitability. They may not be as strong, but we want to understand, is that the case with Realty Income? Do they lag behind the sector? And if not, are we looking at a very strong opportunity to add to our portfolio, not just for long-term growth, but also those juicy monthly dividends? We'll then just let you know, institutional ownership sits at around 71%. There was 2.8 billion worth of sales just over the last year, but in the same time frame, we get pretty much twice as much buying. So clearly institutions are very bullish on Realty Income, but we're also noting in the most recent quarter as well, institutions have been buying more, so clearly very bullish overall. We'll also flag insider ownership does sit fairly low at 0.1%, and yes, we do see around 682,000 worth of sales over the last year, but there's no movement in Q1, no movement in Q4, so you would have to go to Q3 where we see 411,000 worth of sales. Little bit outdated, so we're not going to run through it today, but just something we thought to bring to your attention. Now, in terms of growth from their funds from operations, out of the next 4 quarters, they do anticipate 3 of them to be growth. However, we do want to flag that over the last 4 quarters, they have missed estimates, 3 of them, so only a 25% track record. But if you do believe they can hit their estimate for the the end of the year. As we mentioned, they're trading in the 13 to 14 region, which is not only lower than the 5-year average, as we've already established, but as we showed you, also lower than the sector comparative. Now we're going to run through a few slides from their latest investor presentation, and they call themselves the global leader in a fragmented net lease sector. In fact, they're the 7th largest global REIT with properties in 8 countries. We're going to talk a little bit about that as they have expanded quite significantly into Europe, and they've been operating for the last 56 years. One thing that investors love with this company is not just the monthly dividends, but also the nice increases over the years. In fact, they do quite a few on a month-by-month basis, and since inception, they have been increasing those dividends by around 4.3% year on year. And remember, on this channel, we ideally want to see a minimum of 4%. That is just to keep up in line with inflation. So picture this, you're getting a starting yield near the 6% point, whilst they're also increasing the dividends at least in line with inflation. That does sound fairly enticing. And we can also note, in fact, they have been increasing those dividends on a monthly basis for 130 times. If you can see, just in 2025 alone, there have been 3 dividend increases, although we should point out, if it isn't fairly obvious, that we aren't talking about massive increases. They are fairly marginal, but they do add up year on year. They also like to point out that their growth is stable in a variety of interest rate environments, and when we go back to 1996, we can see there have been quite a few recessions that have taken place that I'm sure you're aware of, but historically the average yield has been at 6%. If you also incorporate around a historical 5% growth to the adjusted funds from operation, then you are getting around 11% in terms of total operational return, and you can see the different periods where they have been slightly above or slightly lower, but overall you are looking at fairly decent return on your overall investment. And again, they do discuss this here as investment spreads persist even as interest rates do start to increase, and the way they've talked about this is essentially when we do get recessions, this environment is very attractive for Realty Income because it then means they can acquire opportunities at a substantially lower rate, which does bolster the overall company. Now if you missed it, they did just a few years ago partner with a blue chip operator in one of the largest European retailers. Some of you may know of Decathlon. Effectively 2023 they purchased 82 assets. We're talking across 5 countries for around $572 million, and this is very strong for the company, something else within their umbrella. And Decathlon in fact is the world's 3rd largest sporting goods retailer, so you can see moves that the company is making. They do think about them. They are very well positioned, not just in the US but also in the international space, and they do pinpoint that here, broadening their own European platform where they're looking at France, Germany and Portugal, but they do also have assets in other countries globally. One thing that really stands out from this company is that out of the last 29 years, every single one of them has had a positive total operational return. 5.5% in fact was the medium growth to the adjusted funds from operation, whilst also increasing those dividends, as we said, 4.3% year on year since the 1994 New York Stock Exchange listing. One thing that we didn't just cover is their very low beta. In fact, we can see stable earnings and low dividend volatility, something that maybe investors who do see this as income that they want to use on their own expenses will love to note. In fact, they have the 5th lowest downside volatility across all S&P 500 constitutions, sitting around 3.5%, and this puts them amongst very large and well-known names like Johnson & Johnson, AutoZone, Ross Stores and Southern Company, where they say are distinguished by low volatility of total shareholder returns. More importantly though, we want to understand what is their portfolio, and they claim it to be diversified and very high quality. Now if you're someone that maybe has been following this channel for quite some time, we've run through this in quite a lot of detail, pinpointing some of the areas that maybe there could be an issue, but we do notice when you do look across every single customer, they aren't massive in relation to their total annualized contractual rent. The first one, 7-Eleven, sitting at 3.5%, and they are fairly diversified across different industries. This includes gaming, restaurants, casual dining, health and fitness, automotive services, and we can also point out the diversification in the geographical sense, with UK sitting around 12%. They also believe that their top 20 clients are resistant to changing consumer behavior. We have service-oriented, non-discretionary, low price point and non-retail. Whether or not you agree, again, that is something just to take note of, but they are also thinking about the future if we do come under more recessions, which they have already gone through since 1994, and at the moment the performance even since then has still been very strong. One thing maybe that doesn't come across our minds is bad debt, but we can see as a percentage of their total revenue has been very trivial, very marginal. In fact, in the most recent year, we are talking around 0.5%, and if you expand this to 2014 to 2024, the last 10 years, even lower at 0.04%. And in fact, if you remove COVID 2020, a one-off event, you could argue it sits even lower at 0.2%. Now, we've already covered European a little bit, but we can see it is something they take through seriously. They are increasing their investment at least over the last few years, and it's something they want to expand, they want to diversify, not just in terms of their clients, but also the geographical locations. And we can see some of their largest European clients. We're talking B&Q, Asda, Sainsbury's, Carrefour and Tesco. Again, I'm sure a lot of people would have heard of many of these names. Another aspect to look at Realty Income is looking in terms of the rates and whether or not we are going to see a reduction over the longer term, because ultimately this does benefit companies in this space like Realty Income. However, we did notice just in the most recent meeting, they did hold their interest. However, what we are seeing here is a potential for 2 cuts coming by the end of the year. And we've also pointed out before, typically when the Fed does start to tighten in terms of the cycles, no more increases. In fact, we start to see this decreasing. REITs have outperformed the overall equity market, as we do notice over the first quarter, second quarter, and in fact over the next 4. So maybe no surprises why when at the beginning of the episode we were looking at the performance of the S&P as well as REITs, they were outperforming, something we could potentially see moving forwards at least in 2025 and potentially 2026. The other thing to consider is their total debt balance, which sits around 27 billion. When we split the fixed to variable, in fact the main thing we are concerned about is the percentage, and fixed is a large proportion, around 96%. In terms of how much that's split at, well, the interest rate is around 3.9%. Their weighted average years until maturity is still quite significant at 5.8, and we could perhaps see rates even lower when they do need to renew it than the 3.9% we are seeing now on average, and the remainder at 4.2%, 1.1 billion is fairly trivial overall, so this is an issue we do see at least in the shorter term, unless something does change this quite significantly. Now, in terms of the underlying metrics, their dividend safety score does sit at 80, it does look to be safe, and as we've noted, they do typically increase their dividend around 4% over the longer term. At the moment, it does sit around 3% over the last year, and when we take a look at that dividend safety score, it was just reaffirmed this month, and 80 safe ultimately means a dividend cut for Realty Income does look to be unlikely. Now, how did they perform in the last recession? That is what this key metric is showing in the 07-09. They actually increased the dividend. They didn't cut it. They didn't maintain it. They had above average growth, -1%. Remember, S&P during this period was -12. And they also outperformed the S&P, although marginally -43, with the S&P coming in -55. As we've already showed you, over the most recent year, 3%. Over the last 5, a little bit disappointing at 2.9. Over the last 20, 4.7, and as we said, pretty much, or in fact slightly above inflation. Now, they have been paying a dividend for the last 56 years without a reduction, however increasing it for over the last 30 years consecutively, and as that is 25 plus years, it does make them a dividend aristocrat. Now, with REITs, we do typically focus on the AFFO, as we stated earlier, adjusted funds from operations. We tend to neglect the free cash flow, as for REITs it is a lot more volatile, so for the payout ratio, we want below 90%, not only below but also decreasing, sitting around 75%, 76 over the next year, so probably no surprises why the dividend safety does look to be secure. In terms of the growth of the AFFO per share, what we want to see, again, typical of when we look at the free cash flow per share, consistent increases over the longer term. Not only is that what we get, but also expectation of that to continue over the next 12 months. And then this effectively leads on to the sales growth, where for REITs we want to see around 5 to 10%. Pretty much what we get and increasing, most recent year sitting at 29%, and the AFFO growth, as they said, on a historical basis, it does sit around 5 to 6%. 5% was just noted in 2024. Expectation though, a drop over the next year to around the 2% point. Then move on to shares outstanding. Now, this is something you need to understand for the industry as a whole. They do dilute your position as a shareholder. Main reason for this is they need it to fund property acquisitions, as they don't retain a lot of that internally generated free cash flow. But one thing we will say, Realty Income, when we compare it to others in the industry, does dilute your position at a faster rate than others. In terms of total sales, well, over the last 10 years, they've increased their top line more than 5 times. Very nice to note. And in terms of the ROIC, one of our favorite metrics, ideally we want to see 10% or more to give us faith management are able to effectively allocate their capital. However, for REITs, 3 to 5% is what we want to note, and that is pretty much what we get, 4% on a trailing 12-month basis. In terms of operating margin, again, fairly consistent around the 50s to mid to upper 40s, sitting at 44% just over the last year. And then we move on to one of the metrics that correlates to not just dividend safety, but also balance sheet strength. That is the net debt to EBITDA. Below 5 is what we want for the industry. Numbers you see below, number of years it would take the company to pay off all of their debt net of cash on hand. 5.56 over the last 12 months, slightly above what we do want to see, but nice to note over the next year anticipated to come down, so it does make sense why we do get that 80 safe score, but again, something to consider and something we will need to take a note of on a quarter by quarter, year on year basis. Now, the end of last year, we did see a few stock downgrades come into Realty Income, and one analyst here, Mizuho, did in fact lower the company to around the $60 mark. They did initially have this company at $64, but it was one, if not of many, that did start to lower it, where they said as a whole for REITs or triple net REITs in particular, they do believe the outlook is slightly cautious, where they noted the impact of persistent inflation and a prolonged environment of higher interest rates. However, this isn't something we have seen. We have noted since this article came out a few cuts, and another 2 is expected at least by the end of 2025. And if you do like Jim Cramer, someone very famous on CNBC, constantly there, he believes that Realty Income is definitely one to consider buying, and this was just from the last few days, but also some people do believe that you should do the exact opposite of what he says. Now, quickly running through other elements, in terms of their growth, they get an A, given the fact the adjusted funds from operation has been growing at 5.3% over the last 3 years and 4.8% over the last 5, both above the sector comparison, so you could argue it doesn't deserve to be trading at the discount we have noted. And their profitability grade also comes in at an A, with cash generated from operations at $3.6 billion, well above the sector comparative at $260 million. We can also note some very attractive metrics on the EBIT margin, with an A- and an A+ on the EBITDA margin, again showing well above the sector in comparison. Now, in terms of total return over the last year, that does include reinvesting those dividends. They are one of the worst performers in the space, up only 12%. When we actually expand it to over the last 5 years, they go from second worst to right at the bottom, 32% plus. And then when we go over the last 10 years, they are up around 78%, going from the worst to the second best. But again, that is, as we will show you right now, lagging behind the S&P. But remember, very important to understand, past performance, not an indicator of the future. They could perform a lot worse, in fact, or they could perform significantly better. Now, just to show you, over the last 12 months, Realty Income has marginally outperformed the S&P, 11%, S&P up 10. However, over the last 5 years, massive underperformance, up 31, S&P up a massive 117 in comparison. And over the last 10 years, again, the continuation of that underperformance, 77%, S&P 179. Now, we also want to flag they have been growing their top line around 5 times, from 1 billion in 2015 to 5.3 just in their latest annual accounts. But we want to understand, what does the bottom line net income tell us? Is the story fairly similar in terms of the growth? Now, the answer is yes, it has grown over the last 10, little bit inconsistent in terms of those numbers, although it has gone from 300 million in 2015, pretty much tripled to 861 in 2024. And finally, we'll show you the balance sheet, a quick health check, total cash versus total debt, where their cash has increased, although again fairly inconsistent. 40 million in 2015, now sitting at 445 million in the latest quarter. But as always, one number in the balance sheet will never give anything away, so we compare it numerically and directionally to their total debt, which has only been increasing as time has gone on, going from 4.8 billion in 2015, now sitting at 27 billion. And as we saw, net debt to EBITDA was sitting around the 5.5 mark, the absolute maximum we want to see for REITs, so definitely something we would say to keep an eye on. Now, just before we get into our own valuation, we want to let you know we have released our latest free weekly article. We draw on every single Monday morning, where we cover severely undervalued stocks, as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll also be able to gain access to a copy of March's undervalued stocks, lots of information for each one, the upside that Wall Street themselves see, over the next year. And on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. And for all subscribers, on Monday morning you will receive a list of all Dividend Kings, a lot of information for each one, the upside that we can note, and in fact a lot of other useful points. Now jumping into the intrinsic value for Realty Income, we get to $64, which is the average of the two models that we do in fact have today. Now we'll run through each one, telling you the inputs and the outputs, but we also want to point out we haven't included the multiples valuation today, purely given the fact that, as we have highlighted, the company does trade significantly lower than the rest in the sector, so it may skew the data, but again, you can see the value if you want it yourself. We have the P to FFO multiple and the average of the sector. If you do compare that, as noted, Realty Income does sit lower, but for those that want to incorporate it into their own valuation, intrinsically $72. We then move on to the dividend discount model with the average growth around 3% over the last few years. Already ran through that, but moving forwards, we've gone for pretty much bang on the same at 3%, where we get our first usable intrinsic value, $65 above the market price of 56, our first undervaluation signal. But as always, we don't look at any one of these in pure isolation. We then have the free cash flow year on year, average growth 22%. We've gone conservative in line with analyst targets at 5. With the discount rate, the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get the $63, another undervaluation signal. So our intrinsic price at $64, although bear in mind, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Realty Income or any others. Now 64, we always like to add a margin of safety where we kick off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that today, a buy at $57.50, then we keep going till it's near the current trading price. And what we're effectively saying in today's episode for Realty Income, you're getting between a 10 to 15% MOS, with Wall Street themselves seeing this at $62 over the next year, translating to 10% upside. Now, for those that want to see it at a lower margin of safety, well, as we highlighted, 15%, $54.34, at 20%, around $51, at 25%, around $48, and at 30%, around $45. Although, as we've highlighted, today around 10 to 15%, Wall Street's price target giving it a 10% upside over the next year. But as always, let us know your thoughts. Do you believe Realty Income, with a monthly paying dividend near the 6% point, increases in line with inflation, which has gone all the way back to 1994, is a strong buy, maybe a hold, or in fact a possible sell? Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us as well in the Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.